Okay, so we're going to talk about gaps today. And gaps are a really, really potent way to make money. And there are all different types of gaps. I'm not going to cover every single type of gap in this meeting because A, I think it's too much information, and B, I'm going to focus on the kind that I think make short-term active traders the most money. Okay? We come in every morning and you game plan and you find a handful of stocks. Those stocks generally, if they're high beta, meaning they're momentum type of stocks, will usually have some form of a gap, meaning that, and I assume at this point we all know what a gap is. It's an open that is higher than the previous day's close, and you can gap up and gap down. For the world that we live in, I find the most effective way to trade gaps are to find the gap and go situations. Okay, so I'm going to just kind of make a note here. Gap and go. Now, the reason that I think they're the most effective is because they provide the most amount of momentum. A gap and go is basically a stock that gaps up. Now, most potent gap and goes, and I'm going to try and diagram this for everybody, will be, let's say, stock closes at,
Don't go much further left.
okay, stock closes at 50, and we mark that off right here, and it gaps down the next day to 45, creating this $5 gap. Now, two possible scenarios. One, buyers step in the morning and stock trades higher and essentially fills the gap. Two, the stock becomes a gap and go type of situation where the stock will ultimately trade in the direction of the gap. Now, these are the gaps that I find to be the most profitable because they're the easiest to find. Not because they move the most or because they have the most momentum. They're the easiest stocks to find because if you're not focused on a gap right away at the open and that gap doesn't get filled, something is happening there. Okay, I'm going to repeat that. If your stock that you're trading doesn't fill that gap, again, the close, and then the open, gap. If this gap in price is not filled in the first hour, that's a problem. That's a problem. So I find the most effective way to trade gaps is not to trade them. What do I mean by that? Well, what I mean by that is I'm addressing the stocks that have gap situations, and I'm going to define this word gap a little more clearly. Well, I'm surprised nobody's asked, does a gap have to be a certain distance? Does a gap have to be greater than 50 cents? Does a gap have to be greater than $1? Does a gap have to be greater than $3? What's the criteria?
You're on that camera. So.
Okay, what's the criteria here that defines a gap? Okay, I'm looking for big gaps. I'm looking for big voids. I'm looking for these holes to be big. And that's all just based off of a percentage of the price of the stock. So if the stock is $50 and it's gapped down 5 points, well, that's a 10%. That's a huge, percentage-wise, that's a huge gap. Those are the type of scenarios that will generally become gap and goes. If a stock is $400, like a Google, and gaps up $1.50, that's not what I would consider a gap and go type of situation. Those are common in those stocks. So you're looking for extremes. I generally think the most successful gap traders are the ones that trade the extremes the most effectively. I generally will shy away from a stock that closes here and opens here. Let's just call this 40 cents or something relatively small. I don't think that's where big opportunity lives. For the world that I live in and the world that we live in, the most effective way to make money with gaps is to find the extremes. Trade the extremes, because the extremes are going to have the volatility. The extremes are going to have the momentum. The extremes are going to have the volume. Those will be three important catalysts for successful gap trading. If you're always looking to fade the gap, okay, it's a term that gets thrown around a lot. The fade. It's a trader favorite. That means you're looking to sell short or trade inversely the direction of the gap. It means if the stock's gapped up $1, you're looking to short the stock, hoping that the stock fills that gap and drops $1 and achieves and touches yesterday's closing price. Now, there are plenty of traders that do that and do that well. But the percentages from what I've found as a trader in my years of experience is that it's never consistent. You never really know if a stock's going to fill its gap. And if it does, it generally does it in such a rapid way that it's hard money. So if you've watched my training videos, I think everybody's well versed in the fact that I hate hard money. It's not where I live. It's not the world that I preach or teach the traders, because the consistency is never really there. Statistically, the amount of traders that can actually trade gaps, trade these scenarios, and make these minuscule situations or these minuscule type of trades very effectively, very fast, very efficiently, just doesn't, statistically, I just don't know that many people. So I look for extremes. And the gap and go is the extreme. And I'm going to show you specific chart examples in a few minutes. But it all goes back to my earlier teachings of, patterns that I like to look at. Okay? The stock closes here and opens down here, creating this gap. And let's say this is a large gap in terms of percentage. The stock is gapped down 5%. Whether it's a news story or an earnings call or some sort of event that caused that stock to have such a large percentage move, that's the scenario I want to look at. Because I know that if this area is not achieved, if this gap is not filled, if this stock doesn't trade up to the prior close, we have in the first hour, I apologize for the scribble, we have what's left. Yesterday's close, today's open, the stock opens, trades up, and then trades back down. This gap, this area right here, was not filled. The gap was not filled. Buyers stepped in at the early morning, made the attempt, but the attempt failed. There wasn't enough buying pressure to stimulate that stock higher. So what happens? After the first hour, again, 9:30, 10:30. And notice, again, this is just my hypothetical, but a lot of times they'll run them in the first half hour, right off the bat. At 10 o'clock, they'll turn back down the other direction. So I'm using my time frame analysis as well as my first hour. Now, what I like to do is, these are the extremes. Stocks do one of three things. They go up, down, and sideways. And it's quite simple when you think about it. If the buyers can't come in, again, this is the first half hour, that's the best opportunity for the buyers. That's when the institutional money and the larger players come in and look for what they would consider value opportunities. So large money steps in, they try and take the stock higher. That's the chance. The stock has that chance in the first half hour. If it is not achieved, and those morning lows get taken out later in the day, what's going to happen? That's when the panic sets in. They tried to rally it. It couldn't rally. The sellers take over. It's really a function of simplicity. So I'm using my gaps, but I'm not using them in a gap and go scenario where I'm just immediately buying something because it's gapped down, or I'm not immediately shorting something because it's gapped up. There are various ways and strategies to trade gaps. This is just one way. There are exhaustion gaps. There are breakaway gaps. There are various types of gap situations that all have specific underlying strategies that we can teach, that you can learn to help you become a more efficient, educated trader. And in this particular scenario, you look for a situation where a stock is gapped up or down with a large percentage. Greater than percentage. Large percentage. And then you look to trade in the direction of the gap. It's actually the inverse from what most traders do. Most traders are always looking for the fade. And while that is a definitive strategy, it is very hard. It is very hard. So unless you are a very quick, active, nimble trader, and I can teach how to do that, but for this time in this session, let's focus on one particular effective strategy. Now I'm going to bring up a chart today because it plays in perfectly from what I was saying. Now, it doesn't matter what the stock is, but I want you to pay attention to the gap and the time frames. Okay, in this particular scenario, you have a stock that closed here right around 114 and opened at 118. So dollar value, we have a $4 gap. That's a pretty large gap. Percentage-wise, I don't know, it's probably a little less than 4%. But percentage-wise, it's still large. Anything greater than 2% is a large gap. The first half hour, what happens? So let's highlight off our gap. Our gap gets filled right at that level. I'm a very visual person, and I find that drawing lines is a very helpful way to paint a picture. So I draw my line where my gap fill is. In the first 30 minutes, look at my clock, 10 o'clock. What happens? It tries to get filled. Sellers come in, and they try to fill that gap. Doesn't happen. 10 o'clock reversal. Boom. Right back to the highs. Now, whether you made money on the initial short or you were trading the 10 o'clock reversal is not what's really important here. What's really important is that you've identified a gap and go scenario. It gapped up. The gap was large. It made the attempt to fill. It did not fill the gap. At some point, you have to think that the stock is going to trend higher. Again, I use the word trend, not a trend in a sense of the stock's been going up for 6 months, but an intraday trend. The stock traded back to the highs, held the highs all afternoon long until the breakout time at 2 o'clock, and like clockwork, the go was on. Gap and go. You see this trade all the time. There's a gap and go scenario every day. It's a very potent way to trade earnings. But again, the trade really lives after the morning. But we as active traders know if you're nimble and you understand what you're doing, you should be aware that the first move, the first sign of weakness you see, and again, let's go to a 1 minute chart. Using our time frame analysis, here's a 1 minute chart. Look at your first few minutes. You could have short that. You can short that because you know it's going to make the attempt to try and fill the gap. Is it the easiest trade in the world? No, it's not. But if you understand your boundaries, you'll know that it'll probably give you a move down to what time? $10 o'clock. 10 o'clock. And then you can take your short off. If that's the way you choose to trade it. So what I've done is I've painted a picture where we understand the macro of what's happening. Stock is gapped up, doesn't fill the gap. That's how big trend days happen. When the Dow is up 300 points or down some extreme amount, how do you think it became like that? They're generally not from intraday reversals. It's because we gapped in that direction, we held the gap in that direction, and we traded higher. Again, extremes. That's how extremes happen. That's the way I like to trade. I like to look for those extremes. Why? Because that's a lot of money there. That's when things make large moves. And I think the most profitable type of trades are the ones that give you the most expansion over the course of a day for the intraday traders. So we know that the stock is poised to go higher. Now it's just a function of how do we time in? And how do we know when the risk reward is on our side? Well, you know because after the first hour is over at 10:30, the stock hasn't filled the gap. That basic simplicity. By 10:30, has the gap been filled? No? Okay, this should be on my radar for this afternoon. Is it at the highs? Keep your eye on it. It's almost, for sake of not sounding cocky, it's almost simple. The logic behind it is simple. We look for extreme gaps that don't get filled after the first hour, and those are the ones with the best likelihood of major expansion in the direction of the gap. It's a very easy, simple, logical way to look at a chart and have a very good idea where that stock will go and why.
Can I ask a quick question?
Sure.
If it didn't try to fill the gap, would you be?
Give him the mic. Let's turn it on. Okay.
Yeah. If it didn't try to fill the gap, would you be looking at it differently?
If it didn't try.
If it didn't have that initial down move at 10 o'clock down to 10:30 and then go back up, and let's just say it went sideways
So you're saying, okay.
to 11 o'clock.
No. The answer is no. It doesn't have to make the, it's a good question. It does not have to make the attempt to fill the gap. It doesn't have to trade in a direction to try and fill the gap. I'm just saying, for the most part, it will always try and push the stock to fill the gap. Because think about it. In order to propel, in this particular instance, the buyers, sellers have to try something. Sellers always try. Now, if in this situation, let's put a hypothetical on the map. We have 1 minute chart here. And in the first, 15 minutes or whatever this is, the stock basically trades in a range. And I'm sure if you wanted to get really cute with your patterns, you can look at it like that. And you could say, and you can do a last special and say, well, I think it's going to go there. But that aside, as I digress, if the stock basically hovers, continues to go sideways, and turns up and takes out this morning high, to answer your question, you got to buy it. Because this hovering, this sideways action, is the sellers trying to push it lower. And the gap and the buyers are just too prevalent and everywhere that it can't even make that push lower. It would make it easier, but so is trading. And that's the world that we live in. So the point being is that, you have to look at these things with a certain sort of understanding of why this is happening. Is there a great significance of why the bottom was right here at 115.36? No. There's absolutely zero significance to that price. That's not some level of support. It's not some major trend line. It's nothing. All it is an attempt to go lower until somebody steps in and says, oh, you're done. And we're not bottom fishing, but we understand the component of what's happening. So if you understand what's happening, it's going to make you a better, smarter, more confident trader. In this particular example, and I'm just using it because it happens to be today and it's in the forefront of my mind, once you see it trade back to the highs and hold the highs, we talk about levels. You see it going sideways. I'm going to try and make this a little bigger. And use multiple time frames. Here's a 15-minute chart. Doesn't fill the gap, trades back to the highs, hovers through lunch, holds that high area. What do you think it's going to do? We're looking for the low-hanging fruit. We're looking for the ones that have the most profit potential. That's why I like this pattern. Because it makes sense and it's expansion, large range, breakout, fast money type of trading. The same rules apply to the downside. So whenever I look at a gap, I'm not just looking at it with one dimensional. Oh, is that gap going to get filled? Let me try and short the gap up. No, I don't want to short every gap up. And no, I don't want to buy every gap down. I want to go where the easiest trades live. And to me, the gap and go is the easiest one. Now, let me throw this out there. Let's say, let me go back to this 1 minute SKF chart. Let's say that the gap is filled. Let's say it trades all the way down and it tags my line. It fills the gap. What does that mean? Who knows what that means? Who knows the significance of that?
Correct me if I'm wrong, but retest.
Okay, a retest. What else? I don't need the specific technical term of what it's called. What's the significance of what's happening?
It's trying to re-enter the range where the sellers had more control.
Okay, keyword being sellers. Who's in control?
Buyers.
Incorrect. Sellers. The sellers got the stock back to the place they wanted to get it to. So our criteria wouldn't work. The gap and go wouldn't happen. So what would I do? Probably nothing. Probably nothing.
Can you describe how you scaled
Take the
in?
mic.
Could you go through how you scaled in and scaled out of the stock today?
Yes. Well, the first trade I took was the trade that I had mapped out for you about 3 minutes ago. Right there. That was the first trade I took. I then covered that trade. And I don't trade large in the first hour. My trades are very, very small. I'm not looking for large moves. I'm looking for quick profits. So I'm able to manipulate these 1 minute charts that show you the most granular of detail. The reason I like to time in with a 1 minute is because the granularity is perfect. It shows you every innuendo of the stock. It shows you the best, most accurate place to time in. Strictly a timing tool. Okay, but you're able to see great patterns in 1 minute charts if you know what to look for. Descending triangle. Well, what's the measured move? The distance of the triangle. So that's the trade I took. It's $1.50. And I knew why I was getting in, and I knew where it was going, and I knew why. And then that was it. And then it was 10 o'clock. And it started to, I looked at it. Didn't look like it was going to fill the gap. Started to turn back up. I scaled in with maybe 100 shares, my most basic tier size, saying to myself, the stock should not be back here. It should have filled the gap, and it didn't. And in my mind, if you watch my play of the day this morning, you knew why I thought it was going to go to 123. Using other time frames and other perspectives.
Being that the SKF is composed of short financials, so AIG, BAC, JP Morgan, Goldman Sachs, do you try, knowing what you know about your measured moves, do you try not quite to ignore, but I don't know, like somehow block out different things that may be going on with those components? As you know, I was definitely looking at the components and at times got thrown off and got shaken out. Though I thought I knew what was going on as far as the measured move goes, you know, the individual components swayed my thinking at times. So how do you go about, you know, dealing with that?
Okay. I'm probably going to give you an answer you don't like. And the answer is, I don't think about it. I don't think about it. I don't look at this chart or this stock, as you know, we're using this as an example, as the major, as the underlying. I know it's the ETF and it's made up of certain select stocks in the financial sector, and I understand the whole concept of what it is and how it's comprised. But at the end of the day, what am I trading? I'm trading a chart. I'm trading a chart. There's really not a lot of thought process involved in it other than I understand the concept of the gap and go. This fits that concept. It's sitting at its highs all afternoon. It's going to go. I don't care what BAC does. I don't care what Goldman Sachs does. I don't care what AIG does. I'm not trading those charts. I'm trading this chart. All that stuff is noise, and it'll cloud your judgment, and it'll cloud your head, and it'll prevent you from doing the right thing. It's a picture, guys. It's a picture. And it tells a story, and it's our job to finish the story. It's picture pages. You ever see that show when you were a kid? Picture pages, time to get your picture pages. That's what it is. And if I sound like a 5-year-old, it's because maybe I think about it like a 5-year-old. Because my whole business is built on the concept of simplicity. I don't make it harder than it is. I don't make it more complicated than it is. I don't need to think about the underlying components. I'm trading a picture. And I use different time frames to tell me different things. And I don't get caught up in every innuendo of every up and down move. Gap and go. Gap and go means what? Gaps up, doesn't get filled, trades back to the highs, holds the highs, and then goes. Gap and go. Same thing to the downside. There's a lot of money in these trades. That's why I'm covering this first. I'm not talking about 80-20s and some other types of reversal trades and exhaustion gaps. Talking about gap and goes. That's how trend days happen. When you see the market up 100, and at lunch it's up 110, and 12:30 it's up 105, and at 1 o'clock it's up 120. Where do you think it's going to close? Probably up 200. Is it rocket science? Not really. And if you don't see this for what it is, sometimes I tell traders, take a step back. Did the stock fill its gap? That's the first question you ask yourself. No. Okay, what's the next question you ask yourself? Is the stock at its highs or its lows? Because we want to trade in the direction of the gap. So we like to see it on its highs. Is the stock on its highs? In and around? Yes. Great. Did it have a nice big morning range? Yes. Perfect. Let's buy it. It's going higher. And you can time in however you need to time in. You can time in with a 1-minute chart. You can time in with a 5-minute chart. You can time in with a 15-minute chart. It all depends on your parameters. And then we apply other basic technical concepts. Well, we look left. Let's just look left, look left, look left. Well, we know there's an unfilled gap right here. So let's mark that off. That gap gets filled right there. It's a good place to take a profit. Never going to sell the top. Shouldn't be looking to sell the top. You should be looking to identify reasons to get in and rational, reasons to get out with basic gap concepts. Does everybody understand the gap and go and why it's powerful? Why it's the first gap technique I'm going to start with. I'm going to do a few of these. We're going to cover exhaustion gaps and runaway gaps and fading gaps. This is a really, really powerful tool to trade from. So you can see what I do. I combine various concepts. I combine my time of the day. I combine timing in. If I really feel compelled to trade the open, use your 1-minute charts to time in and catch that, either that first counter move down or that first counter move up, knowing that I want to take that off around 10 o'clock. And then I evaluate after the first hour. At 10:30, where are we? Gap and go is one of the more simpler, strategic, logical ways of looking at an intraday chart. And there's very few components to it. We like to see a big gap. Because the big gaps, why do we like them? Because they're the ones that have the least chance of getting filled. There's a reason the stock is gapped up $4. I don't care what the reason is. But I know that that gap up is going to be real hard to fill, and those sellers better come in hard right away. I'm going to show you an example the other day. Here's a chart of FSLR. And, oh, I was going to say this doesn't look right. Okay. Here's FSLR. And this day right here, the stock gapped up on earnings. We opened up at 300. The gap was filled. Who was in charge? The sellers. They filled that gap. That gap was filled. Look what happens the next 3 days. Who's in control? It makes sense if you let it make sense. That's a different type of gap. But nonetheless, the concept is what I want everybody to understand. Why gaps are important and how to understand who's really in control and what direction that stock should go and why. So gaps have a lot of information in them, whether you're not even if you don't trade them. There's a ton of information to be sucked out of that gap scenario. To either one, say, well, the gap wasn't filled and the buyers are in control, or the sellers, depending on the direction of the gap. Or two, the gap was filled and something has changed, especially a large gap. The little stuff I generally tend to shy away from. Doesn't usually have a great rhyme and a reason, and there's not a lot of compelling trades there. But it's the large stuff I look for, the extremes. Very, very powerful way to make money. Powerful way to make money intraday, and it's a powerful way to understand the direction of the stock. So that you're not caught trying to get short a strong stock, or you're not caught trying to buy a stock that gapped down and didn't fill the gap. Stay away from doing that. You'll always be on the right side of the tape. You might time in not so well, but I guarantee you'll always be on the right side of the tape. Any questions?
Look, this is a kind of a counterexample. I didn't get a chance to study the chart first, but Cardinal Health, I'm pretty sure it gapped down and didn't fill its gap in the first hour, but later in the day it did ignite. And if you could take a look at intraday, 5 minute. Yeah, the gap was based on the lows, looked like it should do what it should do and defied it.
Yeah, I mean, at the end of the day, you're always going to find, listen, you can always prove me wrong. There's always a scenario you can say, well, Laz, you said gap and go, and it didn't go. All right? Let's take a step back. One thing we know about trading, there are no exacts. There are rules and guidelines that we use. Okay? What's the difference between this and, let's say, the SKFs today that we just looked at? The difference, in my opinion, is that by 2 o'clock, I want to see the lows get taken out. I want to see that morning low, assuming that print's not real, I don't know, but I want to see that morning low get breached because that's my signal. There would be no reason to be buying this stock based on this pattern at 2 o'clock. Zero. Zero reason. To be thinking to yourself, I got to be long this stock at 2 o'clock. because it's going to fill its gap now. 0. It happens to be an exception to the rule. And that's fine.
Is it fair to say that if a stock doesn't take out its morning lows by 2 o'clock, that perhaps you should be looking elsewhere?
Yes. Use the time of day to your advantage. If a stock takes out its low at 340, how much are you really going to be able to pull out of that trade? Why didn't that happen at 1 o'clock? And in trading, regardless of your style or your strategy, there are things you can control and things you can't control. We focus on the things we can control. Okay? Capiche? Thanks, guys. Appreciate it.